All right, so in chapter 8, this is the inventory chapter, and students tend to have problems with this, I think, largely because there's so much flexibility in terms of the system we can use, periodic, perpetual, the cost flow assumption, LIFO, FIFO, weighted average cost. Then you throw in cash discount accounting with the net and the gross method. So there's a lot of different little details that change between different systems and methods within those systems. What will help categorize that, though, is understanding the differences between the systems. For example, perpetual, right? This is the one that we tend to be more familiar with. This is the one that tends to be used more pervasively, where um, at the moment of sale, we record cost of goods sold and inventory. And so we're literally recording cost of goods sold and inventory, thousands of times a day if we've made thousands of sales in that day, right? However, if you think about the periodic system, very, very different. Antiquated to some degree. It has some benefits, so it can still be used, probably by smaller businesses. But under the periodic system, we do not record cost of goods sold after every sale. We could have thousands of sales transactions, and we're still not going to update and determine how much we sold until we're at the end of an accounting period. Likewise, we have no adjustment to inventory as we sell the inventory. We instead, or buy inventory, instead, we go to different accounts like purchases, purchase discounts, purchase returns. And then we update the inventory account at the end of the period with cost of goods sold. So, two totally separate systems. You pile on the gross versus net method, cash discount accounting. It applies to purchasers or buyers as well as sellers. We're going to look at some of that today. And then you throw in the cost flow assumptions, LIFO, FIFO, average cost, different ways of assuming things about the inventory we sold, what was the cost of the things we sold. So there are a lot of variations and it's going to be hard to memorize. And so your best bet is to really develop a working understanding of the process behind each of these. I'm going to go over the journal entries for just inventory transactions, purchasing, basically the purchase transactions, how they differ between perpetual and periodic. We're going to look at an example between buyers and sellers because we've already done some cash discount accounting on the seller side, but we haven't considered on the buyer side. And so I have a problem where you have a buyer and a seller. There'll be some familiar accounting from the prior chapter, chapter 7, and then we'll look at what the purchase side of it looks like. And that's the new piece for chapter 8. And then if we have some time, then we'll start going over how to put it together along with the sale of inventory. So I kind of think of chapter 8 as two pieces. You got the purchase side and you have the sale side, and they're a little distinct. So, it's a good way to, I think, silo stuff and start kind of taking it a chunk at a time. I'm going to switch over to my document camera and just make some general notes about periodic perpetual systems and the journal entries between the two, how they're different. So I'm going to go through all the periodic first because that's the new one. And then we'll compare it with the perpetual system. So under the periodic system, when we have an inventory purchase, that's the transaction. I'm just buying inventory, which we define as something that we have purchased with or made with the explicit intent to resell as part of our core operations. And on the periodic side, when we record an inventory purchase, we do not debit the inventory account. They have a different account that tracks purchases during the period, and it's aptly called purchases. And this purchase account really is what we would call an adjunct asset. So we've talked about contra assets like the allowance for credit losses and accumulated depreciation. This is an adjunct asset. Really, it's just tantamount, it's equivalent to debiting inventory. Okay, because it's adjunct. It goes in the same direction as inventory. There's not that opposite relationship when we have a contra asset where its balance is opposite of the account it's attached to. In this case, it has the same balance as the inventory account, a debit balance, and debits increase it. And so whenever we make a purchase under this particular system, we debit purchases account. And you can assume all inventory purchases are made on credit with a vendor that we have a relationship with and therefore establishes an account payable. So that's, why very much chapter 7 and 8 are great chapters to put side by side because in chapter 7, we're all talking about the seller, recording accounts receivable, recording sales revenue. In this case, we're talking about the buyer. We're recording accounts payable, and the associated expense with buying inventory is when we actually sell it, we record cost of goods sold. So that's an inventory purchase under periodic. If we have an inventory return and we're returning inventory that we purchased. So this isn't an inventory return where our customer returns it. This is we're the seller, we're the retailer, if you will. We purchase some inventory from our manufacturer, the person who provides us our inventory, might just be a vendor. And when we got our inventory that we're going to sell to people, we find some units that are defective, so we need to make a return. In this case, this inventory return from the side of the person who bought something and is now dissatisfied, we would debit if we paid on credit, we're going to debit the liability because whatever we owe less now when we make a return. And we're going to credit not inventory because it wasn't recorded as inventory when we got it, but we're going to credit purchase returns. And so the purchase returns is a contra asset. It's tied again to the inventory account. And if we return it, it's not our property anymore. And it should reduce my total amount of inventory, which is why the credit balance makes sense. Any amount of purchase returns should be subtracted out because this is no longer our inventory. When it comes to paying for the inventory, this is when we can get into a couple scenarios. So let's say we use the gross method for purchase discounts. When we use the gross method for purchase discounts, what does that mean? It means that my purchases account, the one we covered above, is at full value. So we express that at its full sales price, at its gross value, just like analogous to when we use the gross method and sold things on credit, we expressed accounts receivable at full price. We expressed sales revenue at full price. Well, in this case, for purchase discounts, the purchase account is expressed at full price, as is accounts payable. And then just do debit marks into here. So both of these get expressed at their full value. Now, under the gross method, if we do pay in the discount, so we pay off our payable in that discount window, then we have an issue that arises because we have a full valued accounts payable Because remember, under the gross method, we expressed that at full value when we bought it. So this is at 100% value, let's say. And let's just give a discount of 3% for this example, so I can use numbers for the discount as well. So we have a full value account payable, but because we paid the payable in the discount, we get a 3% discount. That means that the amount of cash that I'm going to record is 97% of this value, right? I got my discount, so I took 3% off. Well, now we have an imbalance, just like we had under the receivable side. We have this imbalance where we need to show why these two things are out of whack. And that's that purchase discount that slides in and explains, oh, okay, the reason why we had to pay only 97% of the price of our full payable is because we paid within a discount window that gave me a purchase discount. What is this account? It is another contra asset account. And very much like the purchase returns, is a contra asset, so it has a credit balance. And debits reduce it. So we credit it when we take a discount to show the presence of our company taking discounts on things they bought on credit. This is a debit to accounts payable, reduces liabilities. The credit to purchase discounts reduces assets, and the credit to cash also reduces assets. If we were to pay under the gross method still, and we paid outside the discount, so we paid our payable outside the discount terms. Then we would just have a full price accounts payable recorded at full price because we're using the gross method that sets the valuation terms of that account. And we have to pay the full price cash. So there's no discrepancy to be explained. And so we don't need another account running around in here to explain away why these two are not lining up. Now, on the opposite side of things, if we use the net method, then again, it's going to change these two accounts. We are going to have purchases are always going to be expressed net of discount. And similarly, accounts payable also net of discount. So when we go and purchase, at the point of purchase, before we're even considering paying off the payable, we already record these at their net of discount price. So if we pay within the discount of 3%, then there's no problem because the payable that we're canceling out was recorded when we purchased net of discount simply because we're in the net method. And since we're paying in the discount, the amount of cash we pay is also going to be at the discounted price. So again, no discrepancy going on here. But when we pay outside the discount, then we have an issue because if we're paying outside the discount, the amount of cash we pay is going to be for the full price of the item. And the problem inherent in that is because we're using the net method, when we made this entry, we recorded the purchases at 97% net of discount, the payable at 97%. So this payable that we recorded are owing people money was always going to be 97%. I didn't give myself enough room for another debit. So I'm just going to sneak it in here since I used a pen. But the debit that would explain the difference between these two would be purchase discounts forfeited. for 3%. And it would be a debit. So just make sure you know, since it kind of got off kilter with my not leaving enough room. So we would debit this account for 3% to explain that difference. Why are we paying more cash than the payable that was established on our records? Well, because that payable was net of a discount. We did not end up acting within the discount, so we had to pay the full price cash. And the title of the account, purchase discounts forwarded, perfectly encapsulates that. The debit to the payable reduces liabilities. The credit to cash reduces assets. The one kind of curveball here is the debit to purchase discounts forfeited reduces net income. And it's different than what we see with sales discounts and sales discounts forfeited because these purchase discounts are not an income account. They are related to inventory. How is this going to be a debit when really this should be like, okay, well, we took advantage of a discount, it should raise our overall net income. That's going to wait until cost of goods sold. So it does ultimately affect net income because if you really understand what's going on with inventory and are able to follow the dollars all the way through the process of accounting, what we're doing is putting any purchase amount into purchases, which is essentially inventory. Any inventory we return is recorded in purchase returns, reduces inventory. Any discounts we take are recorded as purchase discounts. And because we paid less for that inventory, it's going to reduce the inventory account. So when we sell anything, any dollar that is in inventory ultimately becomes cost of goods sold because what the inventory count has actually become is just a record of all the costs, either the cost to purchase, the abatement of that cost because we made returns, the abatement of that cost because we got discounts. And the one account that I haven't talked about that is a periodic account is freight. Any freight amount to bring the inventory into our place of business should be recorded as freight in. And that account similarly increases assets, it increases the inventory account. Freight tends to be paid in cash to a third party company. It is just easier to separate from the inventory purchase as a cash amount rather than another account payable. Okay. Freight is that adjunct asset, and so it operates in the same mechanistic way. Debits increase it, credits reduce it. So all the costs to obtain the inventory, bring it to my place of business, netted against all the inventory I returned, subtracted any inventory I got a discount on, we subtract that from the value. This represents my inventory account, but in a periodic system. The distinction when we start operating under a perpetual system actually becomes very easy. And what my recommendation is that you learn how to record under the periodic system first, and then just make a simple translation to get to the perpetual system. Under the perpetual system, purchases, purchase returns, purchase discounts, and freight. All four of those accounts that we just covered in these simple transactions become inventory. So under the perpetual system, instead of debiting freight, we debit inventory. Under the perpetual system, instead of crediting purchase discounts, we credit inventory. Instead of crediting purchase returns, we credit inventory. And instead of debiting purchases, we debit inventory. So it becomes super easy to translate between the two systems when you know how to do it under the periodic system for sure. You learn these names, you learn their debit credit balances, whether they're contra or adjunct assets, and then that translation should come pretty easily. So that's the overall difference in the purchase side of things. One item that I will mention that does not change, and this is the same, this purchase discounts forfeited. This is the same for both systems. This does not change to inventory under the perpetual system. It still is purchase discounts forfeited. And the reason being is that this amount does not end up in cost of goods sold. We only we only have this translation true for the things that affect the balance of the inventory account. And therefore, because inventory and cost of goods sold are so tightly related, any debits in inventory tend to be eventual, So I should say that. Let me say that differently. Anytime we sell something, right, we have a debit to cost of goods sold and a credit to inventory for the same amounts. And so those two dollar values are very tightly related because these all translate directly into inventory. All of these different items also affect our cost of goods sold. Whereas this one, does not. It appears further down the income statement as other income. All right, so I want to move over into the comparison between buyer and seller and really try to link this in with some pieces you already know about selling inventory on credit.